Hey everyone, and welcome back to the channel. Today, we're diving deep into one of the most exciting and potentially profitable trading strategies out there, the breakout strategy. If you've ever stared at a chart and wished you could catch those big, explosive price moves right as they happen, then you're in the right place. We're going to break down exactly what a breakout is, how to spot one, and most importantly, how to trade it effectively to capture that powerful price momentum. Stick around, because this could be a game changer for your trading. So, what exactly is a breakout? In the simplest terms, a breakout occurs when the price of an asset moves above a resistance level or below a support level. Think of these levels as invisible fences that have been holding the price in a specific range. For a while, the price bounces between this floor support and ceiling resistance. This period is called consolidation. Buyers and sellers are in a temporary truce, and the price just moves sideways. A breakout is the moment that truce is broken. The price breaks out of this consolidation range with force, signaling a potential new trend is about to begin. This is where the momentum comes from. It's a sudden shift in the market sentiment, where either the bulls or the bears have taken decisive control. Our job as breakout traders is to identify these key moments and jump on board for the ride. Now, the million-dollar question: how do you actually spot a potential breakout before it happens? The key is to become a master at identifying support and resistance levels. These are the most common areas where breakouts occur. You can find them by looking at a chart and drawing horizontal lines that connect multiple swing highs for resistance or multiple swing lows for support. The more times the price has touched and bounced off a level, the more significant that level becomes. When the price finally pushes through it, the move is often more powerful. Another great tool is to look for chart patterns. Patterns like triangles, flags, pennants, and rectangles are classic consolidation patterns. They literally show you the market coiling up like a spring, building up energy. When the price breaks out of one of these patterns, that stored energy is released, often leading to a strong, directional move. So, start training your eyes to see these patterns and levels on your charts. They are the roadmap to finding high-probability breakout opportunities. Alright, so you've identified a solid support or resistance level. You see the price getting tight, and you're anticipating a breakout. What's next? This is where your entry strategy comes in. One of the biggest mistakes traders make is jumping in too early, only to get caught in a fakeout. A fakeout is when the price briefly pokes through a level, but then quickly reverses back into the range, trapping eager traders. To avoid this, we need confirmation. The most crucial confirmation signal is volume. A genuine breakout should be accompanied by a significant spike in trading volume. This shows that there's real conviction and institutional money behind the move. It's not just random noise, it's a real shift in supply and demand. So, always have your volume indicator on your chart. When you see the price break a key level, glance down at the volume. Is there a big green or red bar that stands out from the recent average? If yes, that's a huge green light that the breakout is likely legitimate. Don't trade a breakout without volume confirmation. Let's talk about the specific entry triggers. There are a couple of popular methods. The first is the aggressive entry, where you place an order to buy or sell the moment the price crosses the breakout level. This gets you in at the earliest possible price, but it's also riskier and more prone to fakeouts. The second, more conservative method is to wait for the candle to close above the resistance or below the support level. This provides an extra layer of confirmation that the move has staying power. An even more conservative approach is to wait for a retest. This is when the price breaks out, then pulls back to retest the old resistance or support level, which now acts as a new support or resistance. Entering on this retest can offer a fantastic risk-to-reward ratio because your entry point is clearly defined, and you can place a tight stop-loss just on the other side of the level. Which method you choose depends on your risk tolerance and trading style, but patience often pays off. No trading strategy is complete without proper risk management, And this is especially true for breakout trading. Things happen fast, and you need to protect your capital. The first rule is to always use a stop loss. Always. When you enter a breakout trade, you should immediately know where your exit point is if the trade goes against you. A logical place for your stop loss is just on the other side of the breakout level. For example, if you're buying a breakout above a resistance line, your stop loss could go just below that line. This way, if the breakout fails and the price falls back into the range, your loss is small and controlled. This is your safety net, and trading without one is like walking a tightrope with no net below. Don't do it. Now for the fun part, taking profit. How do you know when to exit a winning breakout trade? One effective method is to use measured moves based on the prior consolidation range. Let's say the price was trading in a range that was 10 points high. When it breaks out, you can set a profit target that is 10 points above the breakout level. This is a simple but surprisingly effective technique because market movements often exhibit symmetry. Another approach is to use technical indicators like moving averages or simply look for signs of momentum slowing down. If you see the price starting to stall or form reversal candlestick patterns after a strong run, it might be a good time to take some or all of your profits off the table. Remember, nobody ever went broke taking a profit. It's better to exit with a solid gain than to get greedy and watch it all evaporate. Let's put it all together with a quick example. Imagine you're watching a stock that's been trading between $100 and $105 for several weeks. 105 is a clear resistance level. You notice the price is starting to press up against 105 again, and the volume is beginning to pick up. You decide to get ready. The price then pushes through 105 with a big, powerful green candle and a huge spike in volume. You wait for that candle to close at, say, 105.50 to confirm the move. This is your conservative entry signal. You buy at 105.50. Immediately, you place your stop loss just below the old resistance, maybe at 100 for 0.75, to limit your risk. The range was $5 wide, 105 minus 100. So, you set a profit target $5 above the breakout point, at $110. The stock continues to rally over the next few days and hits your 110 target. You exit the trade with a nice, clean profit. That is a textbook breakout trade, from start to finish. It combines pattern recognition, volume confirmation, a clear entry, and disciplined risk and profit management. So, to recap the key steps for a successful breakout strategy, first, identify a clear consolidation pattern, like a range or a triangle, with well-defined support and resistance levels. Second, be patient and wait for the price to break through one of these levels. Third, and this is crucial, confirm the breakout with a significant increase in volume. This separates the real moves from the fakeouts. Fourth, enter the trade using your chosen method, whether it's aggressive or conservative. Fifth, immediately set a stop loss to manage your risk and protect your capital. And finally, have a clear plan for taking profits, whether it's a measured move target or trailing your stop. Breakout trading requires patience, discipline, and a keen eye for chart analysis, but it's a powerful way to tap into the market's momentum. Thank you so much for watching today's deep dive into breakout strategies. I hope you found this guide helpful and that it gives you the confidence to start spotting and trading these powerful moves. Like anything in trading, practice is key. Start by paper trading these setups to get a feel for them before you risk real money. If you got value from this video, please give it a thumbs up, and don't forget to subscribe and hit that notification bell so you don't miss our next video. We've got a lot more content coming to help you become a smarter, more profitable trader. Drop any questions you have in the comments below. I'll do my best to answer them. Until next time, trade safe and trade smart.